Wall Street is bankrupt and they're taking down 401ks with them. And here's the issue, you guys. 401ks are a failed retirement experiment. And it's now clear that 401ks are more of a financial bank bailout and backstop versus an actual retirement investment. So today we're going to show you and talk about the 11 million senior citizens that are forced to work as a result of their 401ks failing to keep up with the cost of living. And we're going to discuss the fact that private equity bankruptcies are at historical highs. And along with these bankruptcies, they also bring mass layoffs, economic uncertainty and chaos, and massive sudden dips in people's 401ks. So we're also going to discuss whether or not investing in gold or crypto is the new best way to get to your retirement. But before we discuss those things, welcome back to Real Estate Mindset. You guys already know this video is going to be absolutely bonkers. Mitch Vexler, how are you, sir?
Well, we have discussed in prior videos multiple issues having to do with the 401ks and various pension plans. In this video, we're going to peel the layers of the onion a little bit deeper to help people understand and ask them, where is your money? Who is getting the fees off of your money? And is that money safe?
Yes, because the gauge to the viewers, of Mitch and I's success is your ability to learn. Before we dig into the data, let's listen to one TikTok video of a woman that just lost $20,000 in her 401k.
Just in case you're wondering if all this going on is actually affecting your 401k, it is. I'm looking at mine right now. I've been checking it every day for the last week because of all this crap going on in the stock market. And I took early retirement because I couldn't take my job anymore after a long time being there. It was affecting my mental health. I had to get that out. I'm old enough to do that IRS 55 rule, which I did. Take a look at yours, because yesterday when I looked at it, it went up. And I'm like, okay, I'll take it. I'm looking at it now. I just lost more than $20,000 of my hard-earned 401k that I need. And now look what happens. And I'm looking at the rate of return right now is negative 0.32%.
So we're going to start with this article titled Private Equity Behind 70% of Large U.S. Bankruptcies in the First Quarter of 2025. This is a big deal. The first quarter of 2025 saw a disproportionate number of large private equity bankruptcies. In fact, 7 out of 10 bankruptcies at companies with over $1 billion in liabilities were at companies that were owned by private equity firms, despite private equity accounting for only 6.5% of the U.S. economy. This continues a troubling trend. In 2024, private equity-backed companies comprised 11% of all bankruptcies and 54% of large bankruptcies. Just 3 months into 2025, the industry is already outpacing that track record. At the core of this instability is the private equity model's focus on short-term gains and rapid value extraction, often at the expense of long-term sustainability. Ouch. Private equity firms have demonstrated over-reliance on cost-cutting measures and aggressive financial policies with limited long-term prospects. Focusing on immediate financial gains can lead to significant mismanagement and economic instability, contributing to higher bankruptcy rate among private equity firms. So we have the data, and this data is telling us that the same thing that happened during the global financial crisis is happening right now, only worse. A critical driver of this instability is the widespread use of leveraged buyouts. A leveraged buyout is a strategy in which a private equity firm finances its acquisition of a company using debt secured by the company it is acquiring. And this is the crazy part, rather than using its own capital, taking on the debt itself. This tactic saddles private equity owned companies with substantial debt, often draining resources that could otherwise be invested in innovation, workforce development, or adapting to market changes. Instead, firms under private equity ownership must channel most of their revenue towards servicing this debt, leaving them vulnerable to financial distress and bankruptcies. But this is also leaving out how much of that money goes towards commission, bonuses, and fees. Bankruptcies are a key bellwether signaling the broader risk associated with private equity investments. For investors and the public alike, bankruptcy trends mark a critical moment and highlight the industry's need for regulation and transparency. And this is regulation and transparency that we were supposed to already have that never got implemented. The human cost of private equity bankruptcies. Despite private equity firms being responsible for a disproportionate number of bankruptcies, the firms are not the ones most financially impacted by the outcomes of these bankruptcies. And you're probably asking yourself, how's that possible? While not all restructuring includes store closures and mass layoffs, the workers at these portfolio companies often have to pay the price for mismanagement and risky debt practices. For 2024 alone, private equity related bankruptcies have resulted in at least 65,000 layoffs. This is likely a significant undercount as it does not include unreported layoffs or closures. Layoffs that occurred in the years leading up to the bankruptcy filings, layoffs outside of the United States, and layoffs across supply chains. Because remember, layoffs spread. In April 2024, 99 Cents Only Stores announced that it was filing bankruptcy and liquidating all stores. This meant closing a whopping 371 stores and laying off its entire workforce of 10,800 people. Private equity firm Aris Management and the Canadian Pension Plan Investment Board acquired 99 Cent Only Stores through a leveraged buyout in 2012. So if that's what they did in 2012 when there was deals, I wonder what people are investing pension funds into in 2025. Any guesses? The private equity firm and pension fund, which pension funds shouldn't be purchasing risky investments like this, bought the company for $1.6 billion, but used approximately $775 million in debt loaded onto the company to finance their acquisition. That's insane. This insolvency not only led to the company's collapse, but put 10,800 people out of work. The mass layoffs can have devastating effects on workers who relied on their paychecks. In the case of the San Diego-based Rubio's Coastal Grill, which filed for bankruptcy in June of 2024, employees not only lost their jobs, but were also reportedly unable to cash their final paychecks. In other private equity-related bankruptcy cases, it is difficult to calculate the full impact of the restructuring on employees because the layoffs occur before the bankruptcy is filed. The repercussions of these bankruptcies extend far beyond the affected companies, impacting employees, suppliers, and local economies. Job losses devastate local communities and reverberate throughout the national economy as suppliers and small businesses feel the downstream effect. Bankruptcies and store closures trigger supply layoffs, compounding the job losses. A 2019 study for the Economic Policy Institute estimated that in the retail sector, for example, when 100 direct job cuts are lost, an additional 122 indirect jobs are also lost, magnifying the economic impact. So I want to read this last thing because I want you guys to understand that people are so greedy and corrupt that even private equity makes money through bankruptcy. The bankruptcy could actually increase their commission. Private equity firms have an outsized role in bankruptcies, but can sometimes profit despite the collapse or restructuring of these firms in their portfolios. For example, private equity owners can exit their investment before bankruptcy despite creating the conditions for the bankruptcy. Golden Gate Capital, for example, exited Red Lobster before its bankruptcy despite creating an unsustainable capital structure that ultimately contributed to its actual downfall. Golden Gate added substantial debt to Red Lobster over the course of its ownership, but Golden Gate was no longer on the hook for the debt once it sold its stake in the company in 2020. So Mitch, greed, corruption, and fraud seems to have a stranglehold on people's 401ks, the greed in Wall Street. Wall Street's overvalued. The second video we listened to, her annual rate of return was in the negative. 11 million retirees are back at work. My question to you, sir, is 401k a failed retirement experiment?
Certain 401ks, if they're invested in the less risky aspect of investments, i.e. index funds, are probably okay. But while Travis was talking, in order to help everybody that's watching this video understand the depth of this problem, it's worse than what Travis had just described. So I wrote a formula. OPM is other people's money, plus the levered bank loans that the private equity uses in order to acquire the targets, plus the incompetence, and I'm going to put incompetence / criminal behavior, and we'll come back on that criminal behavior shortly, equals bankruptcy, equals debtor in possession. So the left hand of the private equity will have another investment side of that organization. Oh, well, we can come in and rescue it, even though we put it into bankruptcy. We'll provide the debtor in possession financing, DIP, and then they make money doing that. Well, that equals the initial investors are wiped out. Debtor in possession gets benefit, massive benefit of trying to rescue the bankrupt organization that they did. And all of that falls under the definition of financial engineering. So what you're beginning to see is a pattern in practice of financially engineering and stripping the money from the initial investors, i.e. mom and pop, and transferring it into highly levered positions that were created by the private equity funds instead of doing it legitimately, which is, okay, we won't put up more than 30 or 40% debt in order to make sure that there's plenty of capital, regardless of what happens to this entity. There's your problem. This is all financial engineering. Those people who have invested in those 401ks and do not know what those 401ks are invested in, or those registered retirement savings plans, whatever it happens to be. If you don't know where your money is and you don't know what the fees are, there's a high probability you are a victim or are about to become a victim.
You guys should know by now that your 401k performance really tracks the stock market. So I want to talk about the stock market, and let's see whether or not the stock market right now is in a bubble at all. I want to bring you guys first to the Buffett indicator, which measures the U.S. stock market value to the gross domestic product. And you guys see right now the U.S. stock market value is at 59.1 trillion. The annualized GDP is 29.5, meaning the Buffett indicator right now is at historic high of 200%. The ratio fluctuates over time since the value of the stock market can be volatile, but GDP tends to grow much more predictable. The current ratio of 200% is approximately 57.5% above the historical trend line, suggesting the stock market is overvalued relative to GDP. You can really see that here in the Buffett indicator. This goes back to the 1950s. So what do you guys think is going to happen? We have this overvalued, extremely volatile stock market. Your 401k performance depends on the stock market. Obviously, what happens next is you bail in and backstop the banks. Retirement assets total $44.1 trillion in the fourth quarter of 2024. We really don't have to guess whether or not 401k is successful. Let's just listen to the people that have 401ks. I want you guys to listen to this next video, which is of two senior citizens that they, both of them, a husband and a wife, had to go back to work because their 401ks were not enough to sustain their lives.
This is certainly not part of Larry Gessick's retirement plan. The 77-year-old electrician by trade leaves at 5:30 a.m. and heads for his part-time job unloading trailers at a local supermarket in St. Petersburg, Florida for $14.75 an hour. His wife, Joyce, 66, prepares for her workday, making $14 an hour as a full-time legal administrator.
It's not really a retirement.
What is it?
It's working every day.
The Gessics came out of retirement not because they wanted to, but because they had to, and are among the 11 million Americans, 1 in 5 over 65, who are still working.
It's hard, 77, still busting my butt.
So I call it the work, retire, repeat syndrome.
Labor economist Teresa Ghilarducci says work is the new retirement.
More than half of the people who are retired right now do not have enough money to be retired.
Who's to blame for all of this?
I blame policymakers who experimented with our retirement system 40 years ago, and they are not saying the experiment failed.
That experiment is what we know today as the 401k, named after part of a 1978 law that offered companies an alternative to the traditional pension plan.
The thought was that Americans just need a little bit of financial literacy and they could just save on their own.
But in fact, many of today's older workers were never taught enough about saving and investing for retirement.
I grew up on a farm. Nobody there instructed any of us to put money aside and make your own way later on down the road.
Mitch, I kind of got a dual question. Once we have a full-fledged market crash, right? Public knows, there's fear, there's panic. How much more can 401ks actually drop and why? But I also want you to answer the question whether or not 401ks are now just really a backstop to high-risk investing.
I'll answer the second one first. There's a very high probability that if the 401k is a mishmash, a jumbled mishmash of underlyings that were sold, and the people that sold it don't even know what's in those particular 401ks, they're subject to extreme down moves, because remember, when a market crashes, the pendulum often swings way over to the left, and that's where the real damage occurs. It's not a question of just losing 10 or 15%. It can actually 50, 60, 70%. Now, eventually things will straighten out. If you've got the staying capacity, you can say, okay, fine, but most people don't have that staying capacity because it's a psychological issue. They will hit the panic button and they don't have control. And what happens is you end up having to pay tax because in many circumstances you took that money out early. I've never been a believer in the 401ks. I've never been a believer in allowing the government, because I've seen it firsthand. I've seen what's happened in Canada. I've seen what has happened with assets held by Caisse de Depot out of Montreal. I've seen these things, and I'm not a believer. I understand the theory where the government says, well, we want our population to have assets from which to retire on. That's on the right hand. On the left hand, the government, be it the Federal Reserve, is the largest purveyor on the globe of inflation. Well, the problem here is that your inflation eats away at your purchasing power. The Federal Reserve prints money, call it counterfeit money, call it whatever you want. They print money. When they print money, that causes inflation, and inflation is a hidden tax. Well, $3,000 in your hands today may not be worth $3,000 in 5 years from now. There's a higher probability that it'll only be worth $2,000. So you're looking at a 30% slice of the purchasing power. That's at your personal level, okay? Now, if you think about it from a 401k perspective, and let's say that that 401k is invested in a mishmash. So they're invested stocks, bonds, be it percentages, 60-40, whatever the standard ratio is that they're quoting on their sales material. The problem is that, as you've seen recently, the bond values are going down and the interest rates are going up. Again, this is a direct result of risk in the market that nobody's talking about. That's why interest rates go up, is because the perceived risk is greater on the principal reduction of the bonds devaluing. So if you think about it, not just at a personal level of your $3,000 turning into $2,000 in 5 years, Well, your investments in your 401ks and your pension funds can suffer from the exact same problem, which is the inflation. Inflation erodes the purchasing power. In other words, the principal of your investment in your 401k or your registered retirement savings plan or your pension fund, it is eroding your principal. Mom and pop are getting hit over the head twice by one item, and that is inflation, which is a direct result of the Federal Reserve printing money. So on one hand, the government says, well, we want our population to have money from which to retire upon. On the other hand, they're making that impossible. We're at the point now where they have printed so much money that, do you realize, but for printing more money, more counterfeiting, they cannot pay off the interest of the debt that they've created? That's why interest is running. So we're trying to peel these layers back so you understand what the connection is between your retirement plan, whatever that may be, and looking at it from the standpoint of what will happen in the future. I want to take one step back and point something else out. Simple in financing is always better. If things are made complex, there's usually a reason for it, and somebody's usually making a lot of money on it. Well, if you think about it, and if you did not have a retirement savings plan 20 years ago, and you said, okay, I don't want to do a 401k, but I want to invest in the market. I want to invest in an index fund. Do you realize that you could have invested in an index fund with no salespeople, nobody pushing any 401ks, nobody pushing pension plans? You just simply say, I'm going to take a percentage of my income, $500 a month, $1,000 a month, whatever it was, and I'm just simply going to go and buy an index fund, up or down, doesn't really matter, for the next 30 or 40 years until I'm ready to retire. Well, if you did that 20 years ago, and you compare that to where you would be right now today in a 401k, there's no comparison, zero. And you did it on your own by simply saying, I am going to go buy an investment, an index fund. And you can do that through a brokerage account, real simple. No money in the middle, no fees in the middle, nobody calling you every month saying, well, we got this stock of the week. Why don't you invest in this stock of the week, to trick you into giving them fees? They're churning accounts to put money in their pocket. Again, financial engineering. They're financially engineering your money into their pocket.
I'm so glad you brought up the index funds, because that didn't take a talking suit that charges massive amounts of commission to put your retirement in. The fact that you just said and demonstrated and explained just an index fund, right? And we'll talk about that towards the end. But Mitch, I mean, wouldn't you agree that these Wall Street maniacs took over our retirement accounts and basically turned that 401k into a free-for-all commission grab? I mean, they're more worried about their commission and making profit than doing the right thing, saving people, bettering people, being a productive member of society. I mean, they're like, oh, bankruptcy? Let's figure out a way to make money through this bankruptcy. I mean, everyone's always trying to figure out ways to take money that is not theirs to make a commission off of it. So, I mean, can't we say that 401ks are more for Wall Street than they are for the actual retiree?
Initially, I firmly believe that the concept behind the 401ks was sincere. The problem, as time has progressed, the computing ability of computers has progressed, has allowed the financial engineering to go hyper. And it's to the point now where it's very easy for a computer to simply say, well, we found this stock over here that's running up. It sends a signal over to whoever is monitoring and say, well, look at this stock over here. We can take our victims and put them into this stock over here. We'll generate the fees over here back into our account. So you've got this financial engineering that in today's world is on steroids. And the pushback is to go simple. You don't need these people. You don't need this industry. Wall Street has always been Wall Street. It exists for the benefit of Wall Street. And if you understand it, that's fine. But part of the problem here is mom and pop saying, well, I don't understand it. Or maybe they don't have the time or to get involved. But my pushback on that is, it's your money. If you don't have the time to watch your money, then Wall Street will do it for you and you can kiss it goodbye.